Good morning, everybody. It's 10 a.m. on Wednesday, March 26th. So here we are for our weekly webinar. Good to see everybody. I hope you're hearing me well. Okay, everything looks good. Everything seems to be working well. We didn't have a webinar last week because I was on a kind of work/vacation. And I'm going to tell you a little bit about that. And I'm over the next few months, I'm going to bring you some things I learned on this trip. But I'm going to talk today about a conversation I had during that trip that really blew my mind, and I'm going to share it with you today because it's kind of a tale of caution. But good morning, Marty. Thanks for popping in and saying hello. But I spent last week cruising the Caribbean, however you want to say it, which was my first cruise ever. I was a little anxious about it, but I had the patches. I listened to a lot of you who had been cruising, but I had the patches. I had this crazy thing on my wrist that shot little impulses into my hand or my wrist, so that I didn't feel nauseous, but I felt great the whole time. So thanks for everybody for their advice. But we spent a good amount of time in meetings and listening to presentations, and I just got so much out of it. And I met some of the most amazing people, really extraordinary folks who are really thinking very, very differently. And so I'll have a lot to bring to you over the next few months in our practices here in our business, and maybe even to our clients. So that was exciting. So one of the conversations I had was with two women we met during the trip, and my wife and I were talking to them over lunch. And I'm going to share this story we had during our financial focus section that is about a spousal inherited IRA, and how this woman's advisor, who is also an attorney and is also a CPA, just got it completely wrong for her. And has caused thankfully it's not anything that can't be undone, but just a huge burden for her, and more stress than she needs, and unnecessary. So we're going to talk a bit about that. We're going to talk all about it during our financial focus, and we're also going to talk about things coming up. So tonight, we are hosting the Psychology of Retirement, based on the Psychology of Money by best-selling author Morgan Housel. And that happens tonight at the Newtown Movie Theater. And we are looking to have a packed house. So if you're coming, get there early. Doors open at, I think, 5:30. But we hope to see you tonight. If you haven't RSVP'd already, please do. You've had a few opportunities to do that, but if you're coming and you want to make sure you have a seat, please make sure that we know that you're coming. So that's tonight, the 26th, starting doors open at 5:30. We're sponsoring, Attleboro Wealth Management is sponsoring the Newtown Theater Wine Walk on May 17th. I actually don't know if we have tickets left for clients. We only had a small amount, and I'm not sure. I'm sorry, I should have checked. I think they may be all spoken for, but if you reach out to us, you can, if you're interested, you can reach out to us. If you're a client only, this is only for anybody can come to the wine walk. Let me get that straight. You can go to the Newtown Theater website, and you can buy tickets to the wine walk. But we have some complimentary tickets that, as a sponsor, we were given, and we're sharing them with our clients only. So if you're a client and you'd like to come to this wine walk, and it's going to be a lot of fun. So different retailers along State Street here in Newtown, Bucks County, Pennsylvania, beautiful town. If you haven't been here, they're going to host their wares and also have different wines. They should be really good wines at different locations. So it should be a nice time. And wait a second. I just got a note from Stephanie, who's handling this for us, and she said 9 tickets left for clients. 9. Wow. All right. So if you want a ticket and you are a client, then you can let us know. Thank you, Stephanie. Way to be on top of things. We're also hosting or helping to host So as a sponsor of Hope on the Vine, that's a local Newtown Rotary event, huge event for them. I think that's their largest fundraiser for the year, and we're really proud and happy to be a sponsor again this year. So if you want to come to that, you can reach out to us, and I'll put you in touch with Stephanie, because Stephanie helps us, and she helps about 100 other organizations, it seems, in the town. So, and then we have an education event coming up at Holy Family University, where we're going to be presenting the Changing World of Retirement Planning. That's the class that you all have come to know and love. So that's the 2-day series. So we have 2 Thursdays, 2 Tuesdays. They're 3 hours each day, so a total of 6 hours of instruction. And that's coming up starting May 1st and May 8th. And that's for Thursdays, and May 6th and May 13th, that's Tuesdays. And then we have an advanced class we're working on. So sometime in April, maybe May, you're gonna see that launched. So that'll be a follow-up to the Changing World of Retirement Planning live class, and we'll let you know when that's live. So just as a reminder of my goals for you for this meeting, or this webinar, I want you to be inspired to make changes. You know, I talked about the journey I was on last week in the Caribbean, and there were only a few other financial planners on that cruise that I talked to, and I think only a few others, certainly in a group. We were in a group of about 450 of us from all around the world on this ship. And there are only a few, I think 3 other financial planners, or 2 actually, so 3 altogether. But you know what I just learned in talking to people, attendees of that cruise, is we do things so differently than most, and I'm very, very proud of that. So I want you to be inspired to make changes about how you're doing things, or you may be doing things today. Open your mind to different ideas and different ways of thinking about planning and investing. You know, I hear over and over again when I'm talking to prospective clients, they say, nobody's ever talked to me about that before. Why haven't I ever? This makes sense. Why doesn't everybody do it that way? Well, everybody doesn't do it the way we do it, because it takes a tremendous amount of work, and we're dedicated to spending the time and the effort. There are easier ways for us to do things. Now, I wish there were easier ways for us to do things as completely as we do them, and maybe we'll get there at some point. But there are certainly easier ways without digging in the way that we need and want to dig in to make sure that you've got the best retirement you can in the most efficient manner. But we do it very, very differently. And so I want you to keep your mind open about those different ways and different planning and investing techniques. I want you to stay educated. That's why I do these webinars. Listen, I love coming to you every Wednesday morning, or the times that we do get together. I don't expect you to be as knowledgeable as us here about everything that's going on, but just have that basic level of understanding and education helps you. Because when I talk about today in the Financial Focus, what this attorney, advisor, and CPA, all the same person, by the way, said to this woman, some of you might come away scratching your head saying, well, geez, even I know that doesn't sound right. So stay educated. I've got a great group of educated clients and folks who are just listening, and that's the way it should be. So use this YouTube channel here as education. Again, not advice, but education. And then, of course, stay updated. Things are always changing, so you want to stay updated so you can make adjustments along the way. Okay, so let's jump into the Slott reports, and I'm going to, during the Financial Focus today, I'm going to talk again and just about how important this Slott group is. So let's look at this together. I have 2 mailbags for you. They're both very interesting, so I want to share them both. So one was from last week and one was from this week, so we get a little chance to have 2. And the first is bankruptcy protection and inherited IRAs. And this is from just last Thursday, March 20th, from our friend Andy Ives. You've all met Andy. And the question is, I cannot find the index number for IRA bankruptcy protection for 2025 through 2028. It is $1,512,350 currently, but it is scheduled to increase on April 1st, 2025. Do you know what it will be? So Mike asked that question. The answer is the updated IRA bankruptcy protection number is $1,711,000 $1,975, effective April 1st, 2025. As you mentioned, this level of bankruptcy protection for IRAs will be in effect for the next 3 years. Note that the $1,711,975 does not include former plan dollars rolled into the IRA, like from a 401k, for example. Former plan dollars remain 100% protected from bankruptcy within the IRA and do not eat into the $1,711,975 cap. So it's really interesting. There was a court decision many years ago now where a judge arbitrarily made up a number saying most people won't have more than $1 million in an IRA, so will bankruptcy protect that $1 million? And it may have been slightly more than that, but $1 million is what's sticking in my head. And it's adjusted for inflation periodically. So that's why today we're at $1,711,975. But as Andy correctly points out, that if you've rolled, say you have another $2 million in a 401k, and you know that 401ks are bankruptcy and creditor protected, then you can roll that into an IRA, and you carry that full bankruptcy protection from that transfer. So that $2 million, I think I said $2 million, that $2 million in this example can be more. If it's $100 million, it's still protected. If you roll that $2 million into your IRA, it carries the protection from the retirement plan with it into the IRA. Now, this is bankruptcy protection, not creditor protection. That's an important distinction. A lot of people make this mistake. They say, well, if it's bankruptcy protected, then it's creditor protected. The two are different, and the creditor protection guidelines or rules are driven by the state. So you've got to know the creditor protection rules in your state. Now, it's been some time, but we did a video about this. It's probably been at least a couple years ago. So if you wanted to find information about that, you can look it up on our YouTube channel. Okay, the next question. And I'll make a point to list that video, reference that video in the description. So next question. I inherited my brother's Roth IRA in 2018 and take required minimum distributions. As we know, they are RMDs. Under the Secure Act, does the beneficiary name on this account continue taking RMDs based on my schedule? If so, do they do so for 10 years and then empty the account in year 10? Or do they not take any distributions until year 10? Thank you, Donna. Well, this is another inherited IRA question because this of course, gets more and more confusing with every change in the tax code. And certainly has gotten much, much more confusing since the beginning of the Secure Act. So the answer is Donna. The beneficiary of your inherited Roth IRA is a successor beneficiary. Since you are already taking RMDs, these annual payments cannot be stopped by the successor. The IRS rules dictate that the successor will step into your shoes and continue with the exact same RMD schedule using the same single life expectancy factor, -1 each year. Additionally, the successor beneficiary must also abide by the add it later or the 10-year rule. So RMDs must continue in years 1 through 9 for the successor, and the account must be emptied by the year 10. By the end of year 10, excuse me. Inherited Roth IRAs and qualified charitable distributions from SEP IRAs. So this is a different mailbag. This is from Ian. The question is, hi, in a recent blog post, you addressed the complicated rules for a 401k to Roth IRA rollover. I have a similar question as it relates to a pre-tax IRA conversion to a Roth IRA. My client is a 95-year-old woman who has a large pre-tax IRA. She has converted some of the pre-tax IRA to a Roth IRA. This is her first Roth IRA ever. That's an important point. Suppose she dies 3 years later, prior to the 5-year holding period being met. The Roth IRA passes to her beneficiaries who fall under the 10-year payout rule. But what is taxable and what is not? Thank you in advance. The answer, hi, Bob. The converted amounts themselves will be tax-free whenever paid out to the beneficiaries. Earnings on the converted amounts will be tax-free only if taken after the 5-year holding period has been satisfied. That period began on January 1st of the year of the first Roth conversion and is carried forward to the beneficiaries. It does not restart for the beneficiaries. So, for example, if your client did her first Roth conversion any time in 2024, her 5-year period began on January 1st, 2024. And even if she dies in 2027, it will end on December 31st, 2028. After 2028, the entire inherited Roth IRA will be available tax-free. Question. I have 3 separate IRAs. I have 3 SEP IRAs with 3 different custodians. I still contribute to one of the SEP IRAs on an annual basis. I am over age 70 and a half. Can I take a qualified charitable distribution out of one of the SEP IRAs I am not contributing to? The answer is yes. A QCD, or qualified charitable distribution, can be made from any inactive SEP or simple IRA. Pay attention to that word, inactive. A SEP or simple IRA is considered inactive for a year and if an employer contribution isn't made to it for that year. All right, so that is the Slott mailbag for today. I hope that was helpful information. Good morning, Denise. Good to see you. Let's talk about the markets, huh? Wow. You know, I've joked in the past that I should short the market when I go on vacation because, like, the day before I left, we started seeing a lot of turmoil, and I can't tell you how many emails I've written while on vacation about market adjustments. But we had a similar situation, and just a few weeks ago, as I was getting ready to leave, we've had a bit of a pullback from that. So we dropped into correction territory, and then for one of the major indices, and then we've had some recovery. As I'm looking at the screen today, it's very, very mixed. But we'll talk a little bit more about that. But last week we saw some indicators come in, and one was retail sales. And this is from our analyst report, and I'll share it with you. The retail sales increased 0.2%, better than the previous month's 1.2% decline, I'd say, but below expectations. The control group, which excludes non-core spending and goes directly into gross domestic product calculations, rose by a better than expected 1%. So our analyst take says, these reports can be volatile, but this report helps ease concerns that consumers are falling off a cliff. The lower end consumer continues to struggle, but investors will be watching to see any reaction upper income shoppers have to tariff uncertainty. Boy, tariff is the word of the day. A lot of indecision, a lot of uncertainty about tariffs. That we had the Fed decision last week. So the Federal Reserve held rates steady as expected, but changed the statement language to reflect more uncertainty. Additionally, the central bank reduced the amount of treasuries that were being run off its balance sheet, a move that was widely expected. The summary of economic projections, or the dot plot as it's referred to, reduced the expected growth rate in the U.S. economy for 2025 to 1.7%, while raising the expected core inflation rate to 2.8%. The committee continues to expect 2 rate cuts in 2025. We'll have to see about that. All right, so here's our analyst take on this. The Fed showed that it has no greater insight into the potential impact increases in tariffs may have than the investor community. So they're saying nobody knows. The Fed doesn't know any more than you about how this is going to impact things. However, the Fed did provide a dovish hint by raising the inflation projection for 2025, but keeping the 2 rate cuts expected in place. Again, expect it. They cannot cut rates. They can keep them the same. They can raise rates if they want to, anytime throughout the year. The chairman did note that the inflation bump that may come from increased tariffs is likely to be transitory. So there's that word again, that transitory inflation is back in our vernacular. What do we have coming up this week? We have Friday, we have the PCE index. The inflation continues to be in focus, and this Fed-favored inflation gauge will be looked at for signs that tariffs are having an impact on prices. And there's a couple points that our analysts made in their market recap for the week that I just wanted to share with you. And I'll just read it to you. They wrote, the tariff uncertainty and concern has reached the point where any semblance of a lesser impact from tariff implementation would likely fuel at least a temporary relief rally. So I don't know if what we saw or what we're seeing so far this week is considered a relief rally or even, I guess it would have been last week. There's just a lot of volatility. And then they write, a reminder that the indexes just barely reached correction territory and that they were coming from high valuations. Remember, we were seeing all-time highs based on historical averages. Corrections are painful to go through at times, but are often the reset in valuations and sentiment needed to set up the next bull run, they said. So we just barely reached correction territory. There was a lot of concern I was hearing out there, not from our clients, right? But so what the gauge for me is always, our clients are very settled. First of all, if they've been with us a couple of years and they've kind of been through these corrections and they see how our portfolio strategies and the account segmentation and all those things you know about now. Remember the 3 pillars, right? Asset allocation, principal protection, and account segmentation. So when we have all those things in place and they're working well, we just don't have concern from our clients. But new clients, so we had, there's a fellow who was transferring in money, and his 401k had dropped dramatically, and he's like, oh, well, his thought was, do I transfer now? Do we rebalance now? Do we hold off on a transfer? All good questions. So I hear it from incoming and new clients. And then, of course, we hear just the buzz on the street, on TV, on just when people, when I go to my Rotary lunch on Wednesdays and people start asking about the market, I know that it's volatile. But we were barely in a correction territory. We just kind of hit it. So we're likely to see more pain in the future. But we don't want to react to that, right? We don't, because we could see just a run up from here, or we could see a significant drop. I tell people I expect a 30 to 40% drop at any given time. Any given day, I expect to wake up and see a significant drop in the market. As I look over to my TV screen right now, the Dow is up, the S&P is down. So I enjoy the ups, of course. We always want to be defensively optimistic, but we want to have that foundation of a strong investment plan driven by a financial plan. And the reason is that as I scroll through, and I'm going to go to other analyst reports here, and then I'll give you the market activity from last week. Let's look at Goldman Sachs. Goldman Sachs reads, amid heightened policy uncertainty, U.S. growth concerns, and waning AI optimism, the S&P 500 has entered correction territory for the first time in 16 months. So again, this is week ending last week. However, history suggests that market corrections often present attractive buying opportunities. In fact, investors have seen positive returns in the 6 months following a correction, 76% of the time, and 86% of the time when excluding recessionary episodes. Investors may benefit from staying the course and seeking attractive market entry points. Well, that's just standard boilerplate. Stay the course, right? They're saying so Goldman Sachs is saying, we don't know what's going to happen. We don't know. We've never had this situation. This is not a political statement, right? But we've never had this situation where we have these potential cost increase because of tariffs and how that's going to affect the global economic structure and, of course, inflation and everything that's involved in it. So they're saying, we don't know, but stay the course. BlackRock says, the U.S. equity pullback has put a dent in U.S. outperformance over the rest of the world. We stay overweight U.S. stocks and see opportunities across global stocks. Europe's fiscal boost may benefit some sectors. In Asia, corporate reforms have lifted Japanese stocks, while some Latin American countries tap into mega forces. Stronger currencies may boost the appeal of emerging local debt, yet we think prolonged U.S. policy uncertainty could dim some of those bright spots. They don't know. So BlackRock overweighted U.S. stocks. That has not worked out for them so far this year. It's one of the reasons that we don't follow the tactical approach of overweighting and underweighting. I can't tell you how many times I've read that BlackRock has had it wrong. So what do you do when these big companies, right? BlackRock, Goldman Sachs, Invesco, you name it. What do we do when they don't know? When the big guns are saying, I don't know. Well, we revert back to our basics, right? So our foundation, our investment strategy driven by our financial plan, asset allocation, account segmentation, and principal protection. Your investments and your time horizons and your withdrawal schedules, all driven by your financial plan. And you update that plan every single year. You don't let it just be shelved. So let's talk about specifics of the market last week. So last week, the Dow Jones Industrial Average was up 1.21%. Year to date, it's down slightly. This is as of Friday, March 21st. Year to date, it's down slightly at 0.91. Year over year, it's still up 7.43%. The S&P 500 was up slightly last week at 0.5%. Down year to date, 3.35. The NASDAQ was up 1.18, negative 7.76. The MSCI World Index, so that's global, large company and large economies, global stock, not including the U.S., is up 9.36%. Emerging markets are up 5.71%. Europe, Asia, and the Far East were up 10.36%. That's their year-to-date numbers. Sorry. Last week was 0.92% for the world index. The emerging markets was 1.16%, and Europe, Asia, and the Far East was 0.79. So even bonds were up last week, 0.49%, almost 0.5%. Bonds are at 2.59% for the year so far. That's the U.S. aggregate bond market. In fact, as I'm looking at it, all the bond indices are up so far this year. So, the non-U.S. company stocks showing us such high returns so far this year, 9.36%, 5.71%, 10.36%. Just goes to show you again that you don't want to target things because international companies have been underperforming somewhat. And BlackRock says, well, we're going to overweight U.S. markets, and this is an example where it's really not helping them. So that goes back to, again, strategic asset allocation. But that's only one leg of the three-legged stool. I know I'm a broken record here, but you need good strategic asset allocation. You need some level of principal protection, and you need account segmentation. And that account segmentation part is what helps people sleep at night. The two really, principal protection and account segmentation, really help you sleep at night and help you achieve your goals. But you can't have those without a proper financial plan. Okay, off of the soapbox. So now we're going to pop into our financial focus. Now it's time for our financial focus section. And today we're going to talk about spouse as an IRA beneficiary. So at the opening of our weekly webinar, which we just finished, I shared with you that I spent a week on kind of a work vacation event, and I spent some time with a person, and she was telling me she recently lost her husband within the past couple of years, and she was telling me how difficult it is, and the first of all, just losing her spouse, of course, and someone she wanted to travel with in retirement, and she doesn't get to do that, and she's spending time with her dear friend, which is really wonderful, but she starts telling me about these, the responsibility she feels in taking over the family finances. So now she's inherited money from him, life insurance, and she's inherited his IRAs, and of course some real estate properties they have, and other issues. But she was talking about the retirement account that she inherited from her husband, and she said. So first, when I worked with the person from my husband's 401k plan, they rolled it into an inherited IRA. And I thought, okay, as she's talking about it, I said, okay, there might be some good reasons for that. And we're having a conversation, and these bits of information are coming to me. It wasn't like speaking with a client or a prospective client where they're giving me all the facts at once. It was we're sitting at lunch and we're just having a casual conversation. So I'm just thinking to myself, okay, that makes sense. There could be a couple of reasons for that. For a spouse to treat the rollover, the inherited, she's a beneficiary of her husband's 401k plan. And there's good reasons to treat that rollover, right, that transfer to her name as an inherited beneficiary IRA. She told me she was 60 years old, but so her husband could have passed before she was 59 and a half. And if she would have rolled that 401k into a spousal IRA, beneficiary IRA, or treated it as her own, and we're going to talk about that. I've got some charts I'm going to share with you. One of there are a few options, and one is to have it as an inherited IRA. Another is a spousal rollover beneficiary IRA, or a spousal rollover IRA. And the other is just to treat it as her own IRA. Well, if she needed, say she's under 59 and a half, and we all know that if you draw funds out of an IRA, um, with certain exceptions, you not only pay tax, but you pay a 10% excise tax on that. So if you're a spouse and you want to keep the ability to draw funds out of an IRA if you need them without paying that excise tax, you'd have to pay regular income tax, but without paying that excise tax, then it could make sense to keep it in an inherited IRA. So that's what's going through my brain, right? Okay. She was under 59 and a half when this happened. So it makes sense that she rolled into an inherited IRA. So then she in the process of her story, she tells me, well, now I have a new advisor, and I love it because he's not only a financial advisor, but he's also an attorney and a CPA. And again, in my brain, I think, okay, that's good. That knowledgeable individual, right? It's been through lots of education, hasn't just passed, some series certification, and that's good. And then as we continue to talk, she says, she's talking about taking money out of IRAs and taxes and things like that. And that's right down my alley. And we start talking about taxes. And she said to me, but, I had to take an RMD this year. And I just paused for a second as she was talking about that because then I'm thinking, and I thought to myself, okay, well, husband must have been much older than her, right? Because husband must have been in RMD age, and now she's required to take RMDs because he was already taking RMDs, and this is what's going through my head. And I said, well, you can why not just roll it into your own IRA then, so you don't have to take RMDs if you don't want to. And also as an inherited IRA, we were talking about Roth conversions. You can't do a Roth conversion with an inherited IRA. You all know that, right? You can convert your own IRA, but you cannot convert an inherited IRA. So I said, why don't you just change it to your own IRA or a spousal rollover? And she said, he told me I can't. My advisor told me I can't. It has to stay an inherited IRA. So that's red flag number one. First mistake. Her advisor, attorney, CPA, all combined, same person, said you can't change it. Now that it's inherited IRA, it has to be inherited IRA. Well, that's wrong. So I gently said, well, you should check that because that's not how the rules work. That would be the case for anybody else, but as a spouse, you have special rules and allowances, and one of them is you can start an inherited IRA and change it to a rollover IRA at any time. At any time, you don't have to do it within the first year or two. There's just at any time. So you can do that and avoid RMDs. And then I said, so your husband was older than you, and she said no. We were the same age. Well, that's mistake number two. So first of all, RMDs. So there's ways to handle the avoidance of the RMD by rolling it into her spousal IRA, as you said. So that can't change an inherited IRA for a spouse. Dead wrong. Her husband was the same age as her, so he would have been 60 years old. RMDs are not required until age 73. Today it would be 75 for them. So I don't know what this person is thinking. And I said, are you sure? He said, it's an RMD. She said, yeah, he made me take it. He said, if I don't take it, I'm going to pay a penalty. Now that screams RMD to me. So I said, I just had to be frank with her. All of my diplomacy and tact was gone. I just said, well, he's wrong. He's wrong, and you should tell him that he's incorrect, and you should check. So as what I did for her was and I'll share this with you. I wrote an email that night or the next morning to our friends at the Slott Group, and specifically Sarah Brenner. Well, I'll share with you. Let me just share this with you while we're talking. I have a quote here from Sarah, and there's a reason I specifically asked Sarah. So I wrote an email to Sarah and I said, hey, I got a crazy question. And I explained to her the details of what I was experiencing, what I experienced from this woman. And I said, do you see any reason why this person would make this recommendation? I mean, is there something I'm missing? Do you see any reason why it would have to stay in an inherited IRA as a spouse, and she would have to take RMDs at age 60 with her husband also being deceased husband, at age 60? And she wrote back and said, no. But she also, and I have it shared with you here, she also wrote, at any point, she can go ahead and do a spousal rollover. That is allowed at any time. I'm not sure why the CPA is saying she cannot do this. In fact, once she turns 59 and a half, I would say there really isn't a good reason to keep the account as an inherited account anymore, and a spousal rollover would be the way to go. So there were some other comments in there, but the reason I forwarded this to this woman, and I said, please share this with your attorney CPA advisor, because Sarah at UC here Sarah Brenner, JD. She's an attorney. She's the director of retirement education at the Slott Group. So I said to her, I'm hopeful that this coming from an attorney who is nationally recognized as an expert in this field, and certainly if this person is an attorney, CPA, and financial advisor working in this space, he certainly should be aware of Ed Slott and his company. There's no other organization that is like the Ed Slott Group as far as education and training for financial advisors, attorneys, and CPAs. So even if he's not a member of the group, which there is no way that he is unless he just joined yesterday, then he knows and certainly understands the high regard that this organization has, what the reputation this organization has. So my hope was he sees this from Sarah Brenner, who's also an attorney, and he recognizes the group. And if he doesn't somehow, he Googles and says, oh, okay, I should pay attention to this, and that he can correct the situation for this woman, because this woman's telling the stories to us about her passing of her husband and the situation with tears in her eyes. Now she wasn't a victim. It was none of that. She was just sad. She was sad that she wasn't traveling with her husband. She was sad that she had all this responsibility. And unfortunately, after we talked, I think she was a little sad that she doesn't have the direction that she thought she had. And she was thankful. Don't get me wrong. She was thankful that I sent her this information, and I hope it's beneficial to her. But that's the situation. And this is why I bring it up, because these are major mistakes, and you have to wonder what else is going on, what else this person doesn't know. And unfortunately, you don't know what you don't know. And I experienced that in 2012. I shared that with you. I was a brand new CFP, certified financial planner. I had just, passed my training, my 2-day, 11-hour exam the first time, feeling really good about myself. And I attended a Slott event, and I did the head slap saying, oh my gosh, I'm missing so much. And I dug in from then. So since 2012, this has been my passion, and I don't mess around with this. I pay attention to great degree and doing all this. And listen, these education webinars and courses, they're great for you, but they're also great for me because it keeps me at the top of my game. I always have to be up to date with things because I can't bring you incorrect information. So I don't know. So these are, the problem is that there are folks out there who don't, and the majority of them. So there's only 500 of us in the Slott Group, and I wish it was 5,000 because people need help out there, and they need the correct kind of help. So we could go to things like this, and I'm actually going to send this to this woman so she can pass it on. But Sarah not only said, all right, answer my question with this great information. She added some other things, but this is most germane to this conversation. But she said, and don't forget, we have this. So I share a lot of resources with you on our website, tax documents and things like that. But I have a lot of other resources in the Slott Group, and this is one of them. So this is a chart, spouse beneficiary options after Secure 2.0. And I kind of have an idea of where this attorney CPA advisor got meshed up in his recommendation, or just throwing his hands up and saying, maybe he said, I don't understand the RMD rules, so just take an RMD. I don't know. But because it's confusing. But listen, that doesn't alleviate the responsibilities of the fiduciary to do what's in the best interest of the client. And part of that responsibility is knowing what the heck the rules are. So this is a chart that the Slott Group put together, and we have charts like this. for many different things and processes. And then we have a whole checklist that I'm going to share with you. But here we have the date of death. So I'm up here. So here we go. We're at the date of death, right? So owner dies before RMD or as a Roth IRA. There are 3 options. And then we line it up. Spouse benefit is under age 59 and a half. So again, these are what you see in this chart was kind of what was rolling around in my mind as she was talking to me. So a spousal rollover, no RMDs until age 73. If Roth, no lifetime RMDs. 10% penalty applies. See, so if she's under 59 and a half and she may need that money, well, then you might want to do an inherited IRA. No RMDs until 12/31 of the year the deceased owner would have been age 73. In my example, in this woman's situation, her husband was 13 years away from that. And in fact, under the rules now, it would have been 15 years. So that's just crazy. But no 10% penalty. So an inherited IRA might be the best option for her until she reaches age 59 and a half. So, but after age 59 and a half, then there is no 10% penalty. She can just do a spousal rollover. Now she can withdraw all she wants. And by the way, she can do Roth conversions, which you can't do in an inherited IRA. What happened there? That was weird. The 10-year rule, you have to distribute funds again, this is a spouse beneficiary under age 59 and a half. There's a 10-year rule, distribute funds by 12/31 of the 10th year after the year of death. No annual RMDs or 10% penalty. Now, if the spouse beneficiary is older than age 59 and a half, but younger than age 73, a spousal rollover, no RMDs until age 73. What does this mean? The ULT. So using the uniform lifetime table. So it used to be with inherited IRAs, and actually still is inherited IRAs. With everybody else, you use a single lifetime table, but for a spouse, you can use the uniform lifetime table. You can still use the single lifetime table for a spouse if it's beneficial to them, but you have to make an election. All right, so no RMDs until age 73. We're here. That's a spousal rollover. No, if Roth, no lifetime RMDs, no 10% penalty. Inherited IRAs, no RMDs until 12/31 of the year the deceased IRA owner would have been age 73. No 10% penalty. And the 10-year rule, you have to distribute funds by the 12/31 of the 10th year after the year of death. No annual RMDs. Spouse beneficiary is age 73 or older. RMDs each year. If Roth, no lifetime RMDs, no 10% penalty. Inherited IRA, no RMDs until 12/31 of the year the deceased owner would have been 73, no 10% penalty. You have to distribute funds by 12/31 of the 10th year after the year of death. So you see kind of how this chart helps guide us with instruction or these questions. And again, these are kind of things that just roll around in my head as people are telling me their situation. If the owner dies on or after the required beginning date, so remember, that required beginning date is an RMD, is tied to the RMD. So if you turn 73 in 2025, your required beginning date isn't until April 1st of 2026. So if you turn 73 in 2025 and you don't reach April 1st of 2026 and you die, anytime between your birthday in 2025 and April 1st, then your heirs don't have to take an RMD. If you cross it over, if you die on April 2nd of 2026 or anytime thereafter, then your beneficiaries of an inherited IRA must take an RMD. I know the rules are confusing. So you can see, I'm not going to read through all these, but you can see the different options if you die before your required, or after, your required beginning date. So that's just a chart, kind of an easy chart. Now I'm going to share with you this. This is where it gets really exciting. So we not only have that exciting chart, but we have a checklist. So what I learned from the Slott Group is that we at Edinburgh Wealth Management have checklists for everything. Slott Group has checklists for everything. All these different things that could pop up. So here is an example, the Complete IRA Care Solution, trademarked, for spouse beneficiaries. So this is designed for financial planners, financial advisors, CPAs, attorneys, and the Slott Group. That, hey, if you don't know these things, If they're not in here somewhere, I'm tapping my head for those of you just listening on a podcast. And by the way, if you're just listening on a podcast, I'm sharing some great information. I think it's great information on the screen here. So you might want to join the video at some point and watch at least the financial focus part. Because remember, we have the whole weekly webinar that's about an hour long, but and we break that financial focus part out in the last 30 minutes or so. So Ed always recommends this, touch nothing. Don't do anything too hastily. There are some deadlines you have to meet, but you have some time, and the new regulations have allowed for more time, but don't do anything. Some people want to push you to invest in certain things or roll certain things over. Just get your ducks in order first. Find a qualified person who knows what the heck they're talking about, and get your ducks in order first. So, he talks about, I'm not going to read you everything on this checklist because I'm going to show you how long it is. Obtain copies of death certificate. Find copies of the beneficiary form. You should have copies of your beneficiary forms. Determine the type of retirement account, traditional IRA, SEP, or simple. I'm here. Roth or company plan. Did the account holder die before or after the required beginning date? Make no contributions to the account. Beneficiaries cannot make contributions to inherited IRAs. Boy, that's something that comes up. All right. So then, now if spouse makes a contribution, spouse will deem to be treating the account as her own, his or her own. That's important. Remember that chart I just showed you? What if somebody needs money and they're younger than 59 and a half? And now because of a contribution they made, that account is deemed to be their own. Then they can't take distributions without paying that extra 10% excise tax. So there's a lot here. So I just want to show you. It just keeps going. Yes, this is complex stuff, but there's tools and resources out there to help people. The difference between, and I'm just going to be frank with you. Look at this. It just keeps going. Right? So we have 8 pages of a checklist to help people avoid issues like this poor woman had that dealt with because her attorney, CPA, advisor, all the same person, didn't know what the heck they were doing. They have the resources. They choose not to use them. Anybody with any financial advisor, CPA, or attorney can join the Slott group as long as they meet some requirements. They have to have ethics requirements. They have to have a good track record. They can't have a bunch of complaints and things like that. People get kicked out of their program every single year for issues. It's not a lot, but there's usually 1 or 2. Maybe sometimes they don't maintain their training. We've got to go at least you have to go twice a year for the first 3 years, and then you have to go at least every year after that. I like to go twice a year. Sometimes I hit some conflicts like I did this year, or I am this year. But anyway, you have the ability to be on the top of your game. Most people choose not to do it because it costs money. I write a check to this organization every single year, and it's not insignificant. It also costs money and time to travel, right? Nobody pays for my hotel room, plane ticket, whatnot. I pay for it. Meals when we're there, so it's definitely an investment, but it's an investment with huge returns for our clients and frankly for ourselves, because I would not want to be in a position where I am calling myself a financial advisor and I am not working to be at the top of my game and not miss anything potentially for clients. We talked about the situation this woman was in. We talked about what the resources could have been. I shared that Slott info, and that I have to tell you. So I wrote Sarah. I don't know what day it was, and she got back to me first thing the next morning. That's how they are. If I send a question, a complex tax or IRA distribution or retirement plan distribution to Sarah at 10:51 today, that's where we are at 10:51 on September 26th. I guarantee I have an answer before 3 p.m. A detailed answer with references. So that's what you should expect. That's what you should expect from the people you're working with, frankly. So what are her next steps? Well, I think she's got to find a different person. I'm not saying it should be us. I'm not saying that. It could be. It's fine. She's a delight. I would love to work with this woman, and we could do great things for her. But she's got to find somebody who not only she's a good fit with, but understands the rules, takes the time and the effort and the the commitment to learn these things, know these things, or know the resources to go to it. Now, if this person just joined the Slott group, they wouldn't have the knowledge of, it's been 13 years. Wow. It's been a long time. I guess it's been at least 10 years, whatever. It's been a long time. That takes time to build up that knowledge, reading, paying attention, reading the updates that we get several times a week, reading, watching the updated webinars, going to the courses, reading the manuals, those thick manuals. That takes a while, but certainly this person could have gone to the website and pulled up the checklist and probably not put the client in the same situation. But the good news is that for her, it's reversible, right? She can move that money to a spousal rollover. She can do a spousal rollover, treat it as her own, and then she can convert it. She can take distributions. She cannot take required minimum distributions until she's 75 years old. So there's an easy answer for her. Good for her. Unfortunately, it's not always like that. Unfortunately, you get bad advice, and you're stuck because if you're not a spouse, you want to have an inherited IRA and you take a distribution. This happens. People say, well, geez, I got $500,000 coming to me in this IRA. Give me a check, and then I'm going to figure out which company I'm going to use to invest that money. Well, now you've taken a distribution that you can't roll that money over. Different rules for inherited IRAs, different rules for non-spouse beneficiaries. So that's what I just explained to you. Isn't even an inherited IRA. It's a distribution. You're a non-spouse beneficiary who took a distribution from an IRA. Many people think you have 60 days to roll that over like you do with some requirements when your personal IRA. It's not the same. And people do that all the time. One of the things that we go over in the Ed Slott updates, I feel like this is an Ed Slott Master Lead Advisor Group commercial, but it's not. I just want to stress to you the importance of being up to date and educated with things. But one of the things I love that we go over is the case law updates, and there's people all the time. You think, well, geez, I wouldn't do that. Well, there are people out there that are going to do it, and it's never ending, and it's not. We don't have to go back even a year to have a mess of case law that's really interesting, that people do really crazy things, and often under with recommendation from somebody, and that defense doesn't hold up well, and these things are most of the time not correctable, almost all the time. But in the case of this woman, her situation, because she's a spouse, she has special allowances, and one of the things is she can correct the problem. She never has to take another RMD. She's stuck with the RMD she had. She didn't have to pay that. She didn't have to pay tax on that. And she could have saved herself some money, but it is what it is. So, and unfortunately, here's the thing. If she and I would have talked before the end of the year, so she did this last year, this RMD, what could she have done with that money? She took that money out, and she had to pay tax on it. Well, if we would have had a discussion before the end of the year, she could have done a Roth conversion, right? She could have taken as a distribution, and she could have converted that money. But first she'd have to change the IRA, but that may have been an option for her. So anyway, these are just thankfully for her, she's got some steps that she can take, and the next step should be to fire her advisor, honestly, and find a person who's knowledgeable and knows what they're doing and looking out for her best interest. So that's the story for today. I hope that was helpful. I hope you got something out of it. It's good to see you all again. I missed you last week. For those of you that are coming out to the theater tonight, I'm looking forward to seeing you. And otherwise, we'll see you next week. Take care.